Well, let's continue with conversation about the budget, but turning to property, we're joined by André Knott, Managing Director of Focus Property Group. Andre, welcome to you. So, a lot of
Thanks, Randy.
discussion clearly about the impact that the budget has had on the property market, whether it's pushed those values down, the implications for investors. On that note, what inquiries have you had, and are those investors looking to actually bail out of the property market?
Yeah, well, thank you, Andrew. Thank you for having me on. But look, it's a really good point you make, and it's something that, in the broader scheme of the market, we expect. I think a lot of the political and also media commentators have been talking about there being a real drop in investor confidence, and we're seeing some of that reported in some of the tabloids. That's not what we're seeing on the ground at Focus Property Group. What we're finding is about a 46% increase in investor inquiry during this period, just in the last 2 months. And we're putting that down to, or what we're experiencing is a lot of people investing or showing interest through financial planners, brokers, accountants, industry professionals that they trust, where they thought they may actually look into the established market. But these industry professionals are saying, well, look, the opportunities still remain for capital gains tax benefits and negative gearing benefits in the new build sector, which is a market that we have as a business focused in on for the last 10 years.
All right, so you then are focused on the new builds. Just to be clear about that, that's how your advice, given that's in the business you're at in terms of advising on property investment. So you're saying that the strategy and then moving to those new builds, but what are the difficulties there? And I guess particularly we talk about new builds and the costs involved at the moment. What do investors need to be wary of?
Well, that's always the ongoing, it's a good question. It's always the ongoing, I guess, fear or pessimism of people looking at new builds to start out with would be that there are rising costs of construction, there's rising costs of labour, and rising costs of supply across the nation, and therefore pushing build prices higher. But typically what we will target for our investors is somewhere in the more affordable range, somewhere between the $650,000 and $800,000 mark, which is well below the median value of properties across most of Australia now. And that tends to be part of the driving factor. Another reason is that the government has now, or the policymakers have actually shut down the opportunity for lending inside an SMSF and for property, that is, and across at least the next couple of years through to the next election, that's going to be the case. So we've got investors not pulling out entirely, but they're actually just asking much better questions. They're looking probably for better yields as a result, because they're factoring in that they may not have the same degree of capital gains across the next couple of years. So they're looking to invest differently, potentially into higher yielding residential property assets and some commercial property assets too.
All right, so actually embracing positive gearing, if you like, given your negative gearing is now a thing of the past, essentially. So, Andre, those that are investors already in the market, then, are you seeing them hold on, or is there any intention to sell given these changes?
Well, I think that's the thing, and that's an excellent point you make. What's happening at the moment is that the established investors, those who have been in the market for some time, as a lot of people are noticing in the marketplace, they are holding back, and not holding back, but they're sitting on their assets. They're not looking to divest them across these next couple of years. I mean, a lot of people I'm speaking to are of the opinion that we're seeing a shift in market sentiment as far as, from a political nature, which way they're going to vote and which way the populace may vote in the next couple of years across state elections in Victoria and New South Wales, as well as in the upcoming federal election in 2028. And so they're holding their assets in established property because they can maintain those capital gains tax and negative gearing benefits. But at the same time, they're still looking for alternative assets. How can we leverage the equity that we've already got in our current assets? how can we actually translate that into opportunities across the next couple of years in some in capital growth, but often how can we actually get some sort of neutral or even positively geared residential assets, because they actually are foreseeing that potentially outside of the next couple of years, there may be a stronger market sentiment at that stage.
Are you region agnostic, if you like, Andre? You see better opportunities in some states than others, or dare I say, inner city, regional areas? Where do you see the opportunities right now?
Well, that's always the ongoing conundrum. Like in my own investing career, I've made just about every mistake you can make across 27 years. One of those mistakes, or great mistakes I've made, is investing at the wrong stages of market cycles, and also investing into far-flung regional centres where the fundamentals are backed up only by specific industries, and not enough market differentiation in the employment sector, you might say. So what we work with our clients in is making sure they get into safer type transactions. I think it's important to realise that a majority of investors, property investors out there, besides what the government may have you believe, or the policymakers may have you believe, they're not rich tycoons. They're people who are investing in their one or two, possibly three investments across a long period of time. We're talking across 10, 12, 15 years. So they're not tycoon type investors. These are mums and dads. These are people just trying to get ahead, just trying to plan for retirement, trying to have a better opportunity in their life over these next decade or next 2 decades, prepare for their kids as well, and help their kids get into the markets. So what we do is we look to position them around the fundamentals of good quality property investing, particularly in major cities, the 5 big capital cities of Melbourne, Sydney, Adelaide, Perth and Brisbane, some of the regional capitals as well, to diversify their investments, but making sure that we're looking to get ahead of the curve, and look to see strong market sentiment in those areas across the next 2 years or 3 years, so they can actually have some equity growth, rather than markets that have been really doing extremely well across the last 3 or 4 years, because we find that clients or investors who get in at that stage, at the top of market cycles, will sit on a fairly neutral type growth curve across the next 5, maybe 7 years, and won't get as much equity increase, won't have as much opportunity to do it again or extract a deposit to go again. So we're looking to get in ahead of the curve. And yes, to your question, we are looking to get them into major capital cities, but at the right stages of those capital cities' targeted growth cycles.